Did Congress just light a $5 trillion fuse under the crypto market? This decision has the potential to create life-changing opportunities and moves for anyone holding Bitcoin or crypto. I've tracked every major macro wave and on-chain trend through bull and bear markets. And today, I'm going to show you exactly what's going on and what's coming next. Over the next few minutes, we'll break down how this bill could inject fresh liquidity straight into Bitcoin and the crypto market. You'll discover why Congress nearly changed the rules for everyday spending in crypto. It didn't go through, of course, but it's not a dud, and we'll get into those details in this show. And I'll also be pointing out the one signal that always sets off a major market move. So the question is, will this $5 trillion firestorm become the next tailwind or instigator for the crypto market pumping, or will it spark the next correction? Hopefully not. Either way, the answer and those details are in today's show. So happy Friday, guys. Happy 4th of July, which is why I'm wearing my flag jacket. Very patriotic, I know, but I do love this country very, very much. Anyway, let's dive into the big, beautiful bill, what's inside, why it matters, why it's causing such a stir across the media, and how it will impact or could impact you, your bags, your investments, and the entire market starting this week. So let's get into it. So first, let's lay down the foundation. This bill is officially known as HR 1 and goes by the name One Big Beautiful Bill Act. As you know, or may not know, Congress moved quickly before the July 4th deadline. We know it was actually approved yesterday, July 3rd. And it's so controversial because it combines both cuts and government spending increases all in one dramatic move, one dramatic bill. And at its core, or at its heart, the bill locks in the tax cuts first introduced back in 2017, making them now a permanent part of the system. Millions of Americans will see more take-home pay, and the climate for workers and small businesses will grow even friendlier. And for people working in restaurants, bars, and the service industry, which we know is the backbone to the American economy and the culture, I would even say, a new $25,000 tip income deduction will be putting real cash back into their pockets. Hourly workers will benefit from a $12,500 overtime deduction, letting more of their hard-earned money, because they're clocking in overtime hours, stay with them. All while meanwhile, companies can now fully expense their investments all the way through 2029, which should stimulate growth and drive new innovation. The estate tax exclusion also doubled, giving family businesses and generational wealth more breathing room than ever before. However, the real headline centers on the debt ceiling point of this bill. This bill raises the US debt limit by $5 trillion, something completely unprecedented, and it fully removes the threat of a default until 2027, which personally I'm happy about, because I don't know if you've been keeping up with the US debt, but it was all due this year. Because just like a loan that you would go get out, you know how there's a fruition date, there's a deadline by when you have to pay it off? Well, all of America's debt was basically due this year, and President Trump just took office. So it wasn't really fair, not that this is about fairness, but it put him in a position of having to deal with debt. That's why he's been complaining about Joe Biden so much, because Joe Biden increased the deficit. He increased the debt tremendously through COVID and through printing and through just like all the auto pen decisions he was not making and people were making through him. Anyway, Trump had to deal with it. His administration had to deal with it. And obviously it's only been a few months since he's been president, so it was going to be literally impossible for him to find a creative way to pay down American debt. So this bill, that is one of the main points in this bill, was to raise the debt ceiling, which is why I can also see why Elon Musk was so upset, because he's been fighting and fought so viciously and was also attacked so viciously through Doge, through his initiative to cut, illegal and fraudulent and unnecessary government spending. So for this bill to come out and now raise the debt ceiling, naturally is kind of contradictory and obviously ruffled a lot of feathers. Anyway, it needed to be done because there was no way America was going to be able to pay its debt. So there you go. So the scale of this debt ceiling increase and tax extension is literally unprecedented. We have never seen such an incredible debt ceiling. And it's essentially going to pour massive fuel into the country's economic engine. And to pay for these tax breaks, because the money had to come from somewhere, the bill actually is going to trim spending on programs like Medicaid, which helps cover health costs for lower income families, and SNAP, the government's main food assistance program. So I can also see how this was so troubling for so many congressmen representing poor districts whose constituents or population highly depend on these programs. So I do, on a personal level, find that a little sad that they would cut that. Now, that's keeping in mind, I don't know how much they were spending on these programs and if it was unnecessary or too much, because you also hear of cases of people taking advantage of these programs by just rigging the system, right? They just lie and they're able to get all these benefits. There's actually a lot of content on YouTube about this. So it sounds a little upsetting and non-humanitarian and a little cold, but once again, we don't know how much money was being allocated to these programs, if it was unnecessary. And you also see, as I previously mentioned, that this bill also encourages people that fall within these tax brackets qualifying for these programs to work harder and get more tax deductions or breaks. I can see how this bill encourages people to go to work and help themselves instead of just depending on the programs, but we will have to see how this plays out. Anyway, just my 2 cents on this. So while this bill trims down on these programs, these government assistance programs, at the same time, budgets for defense, border security, and energy infrastructure were prioritized and increased, especially when it comes to nuclear power, natural gas, and critical minerals. So all of this said, the big, beautiful bill acts as a financial reset button for the US, turbocharging growth, shifting spending priorities, and paving the way for a new wave of economic activity. And one of the most important questions now becomes how all of this new cash will ripple through the markets, and especially how it could impact crypto in the months ahead. But raw spending and tax cuts are just the surface of this big, beautiful bill and the topics within it. The real action is in how this new cash waves move through the system and what it means for crypto when Washington opens the fire hose. Now, shifting gears a bit, let's follow the money. Because every time Congress lifts the US debt ceiling and ramps up deficits, new treasury bonds flood the market. And with this bill, the government now plans to issue over $1 trillion a year in extra debt to keep pace with spending. Investors around the world step in to absorb this new supply, yet risk tolerance always has a limit. Right now, the Congressional Budget Office projects this bill will add $4.1 trillion to America's deficit over the next 10 years, which is shocking. The national debt crossed $34 trillion before this vote even happened. So to cover that gap, the US Treasury prepares massive auctions of new bonds. In May, yields on the 10-year Treasury moved above 5% for the first time in nearly 2 decades. And 30-year bonds returned to levels not seen since the early 2000s. These rising yields create powerful currents in the market, especially for Bitcoin and crypto. Yield curve spikes push investors to reassess where they put capital, and short-term volatility appears in risk assets across the board. A surge in treasury supply unlocks a wave of liquidity inside the financial system. Dollars borrowed by the government move through banks, funds, and global markets. Cash begins searching for returns, aiming for assets with scarcity, resilience, or true growth potential. Bitcoin, with its fixed supply and global presence growing, attracts attention during these cycles. Fiscal expansion brings volatility, then liquidity flows into hard cap assets. The new 5 trillion debt ceiling draws a clear signal. Risk returns, money moves, and crypto stands directly in the path of global capital. Yields break out and volatility surges, and the opportunity for crypto investors grows with every move of this new cash. But all of this put aside, there's something even bigger beneath all of this. Crypto almost got a massive legal unlock, as I was saying in my intro. One that could finally make spending Bitcoin simple in the US. Let's dig into what happened, or almost. While Congress advanced the big, beautiful bill, the crypto community focused on the fine print. A set of tax changes aimed at making digital assets usable for everyday life. And the days before the final vote, the Lummis, remember Cynthia Lummis, and J.D. Vance amendment outlined a breakthrough for U.S. crypto holders. This proposal would have let Americans spend up to $300 in crypto per day, with no capital gains taxes and no tracking for every small transaction. The de minimis rule offered a practical way to pay for coffee, lunch, or payroll without a paperwork nightmare. The amendment never reached a vote in the Senate. Lawmakers removed it during the marathon session. So a true crypto tax fix remains just out of reach. However, Senator Cynthia Lummis acted immediately. This is why we love her. Yesterday, or July 3rd, she reintroduced those reforms as a standalone proposal. So keep your eyes peeled for this. It's now called the Crypto Tax Clarity Act. And this bill preserves the 300 daily exemption, updates the rules for staking and mining, and spells out exemptions for wash sales and crypto donations. So momentum continues to build. The House now plans a crypto week running from July 14th through the 18th, when lawmakers will take up 3 major digital asset bills, including the new Lummis-Vance tax fix and the wider Clarity Act. If these proposals advance, guys, Americans will gain a clear path to spend crypto, everyday purchases, and payroll, all without the maze or the nightmare of micro capital gains. This is a pivotal period for digital asset adoption, and the upcoming votes could shape the way crypto fits into everyday transactions across the country. Headlines have spotlighted tax cuts and the soaring debt ceiling. The biggest stablecoin revolution is already underway, banks and billions in treasuries about to move on-chain. So now let's talk about stablecoins, treasuries, and the quiet giant. In June, Congress passed the Genius Act, which is quite revolutionary. It's a law that allows banks to issue stablecoins, fully backed by cash or U.S. treasuries. And with this new framework, banks are now able to create stablecoins that are fully collateralized by the safest assets available, quote unquote. If anything, it's definitely, how would I say it, like a scapegoat or a moat of protection around the US dollar and the whole US debt business model that the US needs to defend in order to defend its position as the global supreme power of the world. So it is very important for many reasons, not just financial. Anyway, this sets a new standard and moves on-chain dollars closer to a true one-to-one match with cash or government debt, giving stablecoins a stronger foundation and greater appeal for both banks and regulators. So it's also fantastic for the crypto market because we know that stablecoins are, I don't want to call it like a gateway drug, but they're the gateway or the bridge for bringing value and money into the crypto market, because everyone, like all the pairs in crypto, right, are like different stablecoins to the crypto token you're buying. Everything is paired with stablecoins basically. So the more popular stablecoins can become, and the more these stablecoins can back the US dollar, which this act allows for and encourages, that's great. So it's fantastic. It's really actually quite brilliant how it appeals now to regulators and banks, which helps us, the crypto market, and helps the world because now everyone can enter the crypto market. So this regulatory change unlocks a wave of new demand for treasuries. Each time a bank or company issues a new stablecoin, those tokens must be backed by cash or short-term US government debt. By July, the Treasury market absorbed more than $1 trillion a year in new debt, and a growing share is purchased by stablecoin issuers and their banking partners. Circle, the company behind USDC, moves towards federal trust bank status, connecting blockchain infrastructure with the core of US banking. As this foundation strengthens, on-chain volume keeps climbing. Stablecoins settle hundreds of billions of dollars each month across Ethereum, Solana, and other major blockchains. So you see how this steady activity boosts crypto adoption, drives up gas fees, and increases demand for network security and liquidity. So it's this beautiful vicious cycle in the best way. A powerful, powerful flywheel effect spins the market forward. The US issues more debt, stablecoins soak up that supply, and those stablecoins power a surge in crypto payments, as I was saying a moment ago, DeFi activity, ripples, right? And cross-border transfers. Banks and blockchain projects are now linked by shared demand for US treasuries and seamless on-chain money movement. This shift grows into a dominant force behind digital asset innovation, and each additional dollar of debt opens new liquidity and opportunities on-chain, shaping both traditional finance and crypto in real time. But every engine can stall, right? Not to be the devil's advocate here. So let's talk about what could backfire, because it is important to know both sides of the coin, positive and negative, so you know how to plan. So here we go. How could it backfire? Well, adding $5 trillion to the national debt always triggers consequences. As the Treasury releases new bonds into the market, investors pay close attention to supply and pricing. When buyers hesitate, yields climb rapidly, sending shockwaves into risk assets like Bitcoin and the entire crypto market. Recently, for instance, 10-year Treasury yields moved above 5% for the first time since 2007. 30-year yields also continued climbing, reaching levels markets have not seen in decades. And historical patterns show that when real yield on the 10-year Treasury rises above 2%, Bitcoin faces stronger headwinds. Higher yields allow investors to secure safer returns in bonds, reducing demand for risk. Sudden yield jumps create fast pressure on crypto and other risk assets. And remember, this bill reduces Medicaid and SNAP spending by $110 billion over the next decade. Legal challenges are already underway, with lawsuits contesting these reductions. If courts block any of these planned cuts, the deficit grows further, placing additional upward pressure on yields and volatility across markets. Short-term effects bring turbulence. Large yield moves can spark liquidations, rapid price swings, and pullbacks in both Bitcoin and altcoins. Policy watchers right now recognize this period as a real test for government borrowing and risk markets. And in the long term, the new debt ceiling and the surge of treasuries push investors to search for hard cap assets and new sources of yield. Macro forces shape every phase of crypto's evolution. This is why we go through it. Each move in yields and policy sets the tone for what comes next in Bitcoin, DeFi, and the wider digital asset landscape and market. So where does this all actually leave us? What do we do with all this information right now? So let's recap. The US government's new fiscal policy injects trillions into the economy. This $5 trillion shift is already reshaping the landscape for Bitcoin, stablecoins, and DeFi. Every new round of US treasuries adds fuel for stablecoin growth and brings more capital onto the blockchain. So with Congress set to vote on crypto tax clarity and new regulation, and banks building stablecoin products, the connection between traditional finance and crypto keeps getting stronger. Watching debt levels, yields, and policy changes is now essential for any crypto investor who wants to stay ahead. So let's continue to stay plugged in. I'd encourage you to watch and continue to tune in to my videos because it is my commitment to you to stay extremely plugged into the news. That's all I binge on all the time, and bring it to you Monday through Friday so you are informed. Knowledge is only potential power. It's what you do with it that then is actually powerful. But anyway, guys, thank you so much for your support. Thank you for every like, every comment, and for subscribing. these past 2 weeks, our channel has grown tremendously, and none of it would have been possible without you. So truly, thank you so much. It's so encouraging. And if you didn't watch yesterday's video, it's nice and short, it's to the point, and I dare say it is concisely synthesizing and captures this moment in time in terms of where we are in the crypto market right now, and could be really great for you to share with somebody that, you know, is unfamiliar or is still skeptical about crypto. And it's under 1 minute, so it won't take up a lot of their time. So feel free to watch it here, and let's keep riding this wave together, guys. I love you so much. Have a wonderful weekend. Happy 4th of July if you're in the States, and I'll catch you guys here on Monday.